Companies communicate financial information to stakeholders using 4 financial statements. These 4 statements are prepared by accountants in this particular order. First, the income statement. This statement informs stakeholders the details of revenues and expenses during a specific period in time. Examples of reported period in time include month, quarter, year, or some other division of time that allows the statement to be comparable to the company's or similar outside companies' time periods. Most companies follow the monthly, quarterly, and yearly time periods for financial statements. However, there are companies who follow a different time period. For example, Starbucks reviews performance from Monday to Sunday each week. Accordingly, the end of their fiscal period is on a Sunday regardless of the actual date. Their fiscal year end is the Sunday closest to September 30th. As long as they have a sound reason for the selection of the end of the period and they apply it consistently, they are considered in compliance with generally accepted accounting principles. The next statement, the retained earnings statement, informs stakeholders how much of the earnings from the income statement from prior and current years remain within the company. Profits of the company will increase retained earnings, while losses and payments back to shareholders known as dividends will decrease the value of the account. This statement is presented in the same time period reference as the income statement. The balance sheet is a statement that provides stakeholders with a view of the financial condition of the company at a specific point in time. So, if the income statement is showing the revenues and expenses of a company for the 12-month period ending December 31st, the balance sheet will show the financial condition of the company on that specific date, December 31st. The information on the balance sheet follows the accounting equation assets equal liabilities plus stockholders' equity. This equation is very important to remember as we go through this class. Assets are the resources that the company uses to conduct its business. Liabilities are the obligations or commitments the company needs to fulfill to its creditors. Stockholders' equity are the investments made by the owners of the company. The final statement is the statement of cash flows. This statement shows stakeholders where the company receives and uses its cash for a period of time. This time period should be the same as the income statement. When you look at a statement of cash flows, you should note that the sources and uses of cash are categorized by the same business activities that we have talked about earlier. Here is an example of an income statement. Note the title of the financial statement. The titles are very important since we want to make sure that the reader of the information knows which company is being reported, what information is being presented, and for what date or period this statement is for. The primary purpose is to make sure we are very clear as to what information is being provided. Take a look at the income statement. We can provide a simple equation in this report. Revenues minus expenses equal net income. Notice the titles for each section are flush left on the page. As the statement provides more detail to the category, we indent the more detailed description. Take a look at the numbers on the right. The totals are flush right on the page. The details that make up that number are indented to the left. One final point of interest. Notice the dollar signs at the beginning and end of the columns. We want to make sure the reader knows what currency is being reported. Generally accepted accounting principles requires the financial statements to be presented in the currency the reported company operates in. So, a US-based company would report their financial information in US dollars. Once we calculate net income, we need to use this value for our next statement. As we mentioned, the statement of retained earnings shows the earnings that are being kept in the company and have not been returned to the shareholders. This statement shows the income statement and uses the net income previously calculated and adds it to the retained earnings the company started with for the period. Dividends are payments or returns the company makes to the shareholders. Accordingly, as the company pays the shareholders a portion of the profits, it is no longer part of the company and is no longer invested in the company. A company needs to make a decision as to how much money does it want to retain and how much to return to the shareholders. Retained earnings are used by the company to finance future growth. Shareholders are looking for a return on their investment. Management needs to find the balance of meeting the needs of the company with the desire of a return on the shareholders' investment. Many times, mature companies make regular dividend payments to its shareholders, while growth companies retain the profits of the company in order to finance future growth. Now that we have computed the ending retained earnings balance, we will use it for the next financial statement. As mentioned before, the balance sheet shows the financial position of a company on a specific date. Note the way the date is represented on this statement compared to the income statement or the retained earnings statement. The balance sheet shows the reader the elements of the accounting equation. Assets equal liabilities plus stockholders' equity. Note, it is this example that the total assets equal the total liabilities and stockholders' equity. If you were to create a balance sheet, these two values must equal. I like to relate assets as company resources, liabilities as company obligations, and equity as stockholders' investment. Note that the ending balance in the retained earnings statement is the same number as the balance in the balance sheet for retained earnings. Note some of the tips on the right of the screen. One other thing, normally the items are listed in the most liquid or the use first order. In other words, cash is the most liquid asset of a company. Notes or accounts payable will be paid off before the other financial obligations of the company. Notice here, the cash balance on the balance sheet will be the same value as the ending balance on the statement of cash flows. As we mentioned before, the statement of cash flows tells the reader where the company received and used cash. Notice that the statement is broken up by the three different business activities: operating, investing, and financing. We will spend more time on this financial statement at the end of this class. Generally accepted accounting principles requires that readers of financial statements are provided adequate information for them to make good decisions. So, it is important that there are adequate disclosures that accompany the financial statements. For publicly traded companies, these disclosures are put together annually in the form of the company's annual report. The annual report includes the financial statements, management discussion and analysis, footnotes, and the report of the independent auditor. The independent auditor is a certified public accountant or a certified public accounting firm. The management discussion and analysis portion of the annual report is management's discussion of where the company has been and where they are going. It is in this report that management discusses where they stand and what their plans are for the future. As this slide states, the footnotes help clarify the financial statements and provide additional detail. If there is a possibility of a question as to how a number was calculated or the method of accounting in an area, the footnotes would explain the process. Also, there are times when a business activity may not show up as a transaction on the financial statements but needs to be disclosed to the reader. Because of the need for complete disclosure, the footnotes would be used to provide additional information. In order for the stakeholders to receive a level of assurance that the financial statements and their disclosures are accurate, the financial statements and the disclosures are subject to an annual independent audit by a CPA or a CPA firm. While it is almost impossible to expect 100% accuracy, we want to make sure that the information is fairly presented. Think of the word fairly to mean that the information is correct as much as possible and that all the material items have been reviewed. If anything is incorrect, it would be so small that it would not affect your decision making. Today, this class will be teaching you generally accepted accounting principles as it relates in the United States. In a few years, the U.S. will be joining its fellow international accountants and businesses by moving towards International Financial Reporting Standards known as IFRS. There are some differences that the IASB and the FASB are ironing out, but for the most part, U.S. GAAP and International GAAP are pretty consistent. Throughout your textbook, there are pieces of information related to the differences between GAAP and IFRS. Please note that things will be changing in a few years, but for the most part, you can see that the changes are not too significant.